Welcome to Unblocking the Chain. Today I am joined by Pete Dunworth, one of the gladiators in the Bitcoin ecosystem in Australia and globally. Pete, welcome to the show.
Pleasure to be with you, Ash.
It's been a long time covering this. You're a visionary in the space, travel extensively and meet people all over the world. Why don't we start with a little bit of background about Pete Dunworth? Where did you come from? What were you doing? And then we'll talk about how did you get to Bitcoin.
Gotcha. Well, depending on where you want to start, we'll probably fast forward the first 20 years or so. But studied accounting and finance. Accounting, very boring, or I thought it was at the time. And it's ironic because ended up focusing on a triple entry ledger system in Bitcoin. But studied accounting and finance, went into BT funds, first job out. Then set up a mortgage broking business, was in that for close to 10 years, got to see the credit side of things. That was a lot of fun and some very interesting characters there, some of whom I still have a great relationship with today. Lots of stories there. And then moved to the other side of the balance sheet, just pre-GFC, where spoke to a very dear friend of my father's and his advisor, who at the time I think was chairman of Perpetual. And he said, Pete, you're on the wrong side of the balance sheet. Your life's about to get very hard very soon, which proved to be exceptional advice and quite luminary. So moved to the other side of the balance sheet, focused on equities and financial advice, which encapsulates a whole host of issues and topics. And fast forward a few years there, moved into a family office looking after some high net worth families and giving them advice across a whole range of asset classes and structures.
There's a lot to unpack there. So you've gone from the traditional accounting space into mortgage broking, a massively growing market in Australia over probably the last 20 or 30 years, and then back into how to preserve / make family office money.
Yeah.
I think that encapsulates probably why we're sitting here today. How did you come to Bitcoin through all of that?
Sadly, very slowly. And I wish I was a little more receptive to it. And to anyone who's watching this, part of the messaging that I like to get out there is Bitcoin, when you first hear it, it does not resonate. It breaks all the norms of traditional finance. And sadly, I had probably close to 20 years of traditional finance education and experience, which precluded me from really understanding what this is because I had a whole host of preconceived notions. But the very painful story that I love sharing is back in 2011, nearly 14 years ago now, my brother said to me, Pete, you should have a look at this Bitcoin thing. I think you should get some. And sadly, there was too much hubris, too much bravado. I was the finance guy. I understood finance better than you. That'll never work. Governments will shut it down. I'm not wasting my money on that. And that was sadly at a point when Bitcoin was $3 a coin. So I probably wish my brother in hindsight had been a little more persistent that, hey, just throw 5 or 10 grand into it and it'd be a very different conversation today. But he then went into business over in the States, set up an exchange, and being able to speak to him on a daily or every other day basis, got to understand what Bitcoin was. And sad to say, I'm a very slow learner. It took me 5 years to understand what this is. There is maybe some forgiveness in the fact that there weren't the education pieces out there. There weren't the podcasts. There weren't the books. It was very early days, but it took me 5 years to understand what this was and then start moving client money into that.
The $3, I hear you still got it at an okay level, is what I'm hearing. So I'm not too woe is me at the moment, Pete. The interesting fact that we're all speaking to these type of customers, potential customers, as a high net worth family office or multi-family office sort of provider, and traditional wealth managers, lots of wealth in Australia. Why do you think there's the reluctance to get involved? I mean, if you look at the performance, the volatility is high. We all understand that, but coming from our perspective, that's a feature of it. Why do you think there's such a reluctance?
I've spent so much time trying to figure this out, and what is the key that unlocks that understanding of Bitcoin? I think one of the first financial lessons we're probably given from our parents is that if it's too good to be true, it probably is. And that causes a red flag. If I say to you, hey, do you want to have money that has absolute digital scarcity? Firstly, people go, what does that even mean? It's never existed before Bitcoin. Well, would you want something that you can have full control over that no one can take from you? I don't really understand the need for that because I'm not a Russian citizen who had my foreign reserves stolen, or I'm not a Canadian trucker who was banned from the banking network. We live a very privileged life here, and there's a lot of really good things about Bitcoin that we kind of take for granted in Western democracies because we have it good. We have a great working banking system. We've got great property rights. And quite frankly, when you look at an asset that has gone up as much as Bitcoin in the last 15 years, it's very difficult to get excited and understand that there's actually more gains in front of us than behind us. There's an immediate dismissal that, well, it can't continue to do that, but hold my beer, we're going to see what happens over the next 10 years.
And in the sense of the multifamily office role that you had and still have, as well as this, the Bitcoin advisor, is how do you think about allocating? Obviously, there's an education process, which, we all think is very important, getting people comfortable. You run portfolios, holistic portfolios for families as such. How do you think about allocating in that space for traditional asset classes, ballpark percentages in the portfolio?
It really comes down to looking at each family as an individual. And in Australia, we've got a large bulk of our wealth is tied up in property. So most clients who come to us have large amounts of property. That's a fairly illiquid asset class. There's difficulties in changing asset allocation for someone who's very heavy in property. And so there's a much smaller allocation to the traditional, more balanced portfolios where you're looking at bond stocks and, say, the alternative assets. And this is what is really interesting from my point of view, is that you look at, say, the Future Fund, arguably the biggest fund in the country, how they allocate and think about risk. And this is where I think from an Australian perspective, you just need to look at the stats that as a country, we underestimate the risk associated with the Australian property market relative to every other investment. And as such, we are heavily invested in that. And not only are we heavily invested in it, everything revolves around, from an economy or economic perspective in Australia, really the property market. If you look at our Australian stock market, it's really just a leverage play on property. We've got property REITs, we've got development companies, and arguably the biggest property companies in the country are the banks, because they're just a leverage play on property. So I look at this and I think from top to bottom in society, from top to bottom from a government perspective, we are heavily tied to property market, and as such, everyone is invested in it. So there is this common interest in ensuring that the property market in Australia doesn't blow up. But from an allocation perspective, I can tell you that 95% of Australians are heavily overinvested in the Australian property market. And this is where there hasn't been the ability to diversify quite like we have with the opportunity in Bitcoin. And when you barbell that, you'll be heavily weighted to property. But at the same time, that represents the opportunity to de-risk yourself by what most people are convinced is a really risky asset. But I make the distinction between risk and volatility. To me, I think Bitcoin is the risk-free asset and the Australian property market is risky. Having said that, the Australian property market is not volatile because it's steady, and the way that our banking system works and the mortgages attached to it ensures that there's continuity of service, for want of a better term. Whereas the volatility of Bitcoin scares people because they think, it could drop 80%. So there's a lot of things to sort of toss up there, but there's a complete mismatch from what I see, having studied this, relative to having the last 30 years of my life looking at property.
I think it's really interesting, and I think a lot of people are unaware of how correlated the asset classes are in Australia. And a lot of the offshore investors have looked at this properties, super funds, banks, houses, it's the same trade, right? And there's some correlation to the currency as well. So it's all the same trade. The way I sort of think about Bitcoin now, and you're alluding to, is it's not correlated to that correlation risk, right? And correlation tends to go towards one, so everything's the same. When risk is off, it correlates to one. So I totally agree with this. I think it's a hard trade to fight, and people try and short these type of markets. It's very difficult because it is the system.
Yeah.
Right. I mean, the risk, if we have a substantial problem in the residential property market, the system's in a lot of problem, right? The government, every level, right? Government, corporate, household. So I think there is there will be a backstop or, the propensity by officials to try and slow that and smooth that down. It also holds a substantial amount of superannuation, retirement money in residential property as well. So I'm totally in alignment, and I just think, people should consider non-correlated assets in this country, particularly, to the system. And so, a lot of the commentaries and education is around the US and potential emerging markets. I think Australia's got its own, idiosyncrasies to what is the risk.
Yes.
And I don't think I don't think the market gets absolutely belted, but I think it's all the same trade. If you are the ASX, property, super funds, et cetera, you need something else. And my next question is, there's obviously a revolution back into the sort of private debt and private credit markets as
somewhat a disaster.
Somewhat not correlated, but I think there's issues there as well, right? And overall, I just think, there's more and more debt. The banks stepped away from the SME corporate type lending and is getting filled in either by sort of, SME lenders or these private funds now. And now there's some great people who manage this money and are very good at it. But I think the velocity of people trying to do this is concerning. And some of my contacts are, very concerned about, if everything's fine and there's no interest rate pressure and et cetera, no, it's okay. Any stress or there's any workout requirement needed, there's a lot of issues with that.
Yeah. This is where I look at it. It's people don't understand the weight of capital and what that does to returns. So when there's no one in the market, you can have huge returns. But as weight of capital comes to it, it normalizes the returns and basically pushes it down. And at the same time, it pushes the risk up dramatically. But because people are piling into this asset class, they think, oh, it must be okay. It must be good. But I sort of pose this to you is that we've got institutions in Australia, some of the most successful banks in the world, who have stepped out of these markets that private lenders are stepping into. Now, our banks are no fools. They've run successful businesses, arguably some of the most profitable banks on earth. And they're saying, we're not comfortable with the level of risk in this. And it's being replaced by private lenders who don't have a 150-year track record, don't have guys with 50 years or 25 years of credit experience looking at what could go wrong and stepping in because we can get a marginally higher return. I look at this and think that the level of risk that builds up in a system that has this type of private debt, and I don't think I'm the first person to be talking about it. I know we've sort of talked off air about this. This represents, I wouldn't say an existential threat, but it's definitely a systemic risk that needs to be addressed because there's now so much capital in that space. And at the same time, returns are dwindling. And there's this weird thing that happens that people think because the longer it goes, the less risk there must be. But in this instance, I actually think the longer this goes, the more risk it builds up. So just yesterday, I was talking to a property guy who's talking about returns that can, he can put cash in and get 15% return on his money. And that's enough to pay the money manager, 2 or 3% fee that he's charging. So they're getting, developers are getting money at 18, 15, 18%, trying to make money on it. I'm thinking, I struggle to see, where the positive skew or positive outcomes are going to come for this.
I mean, I agree, but I just think any business that's paying 15 to 20% away, what does that do to your cash flow?
Yes.
Like, it just is that sustainable? Now, I get it for bridge and finance, and if there's, a short-term stress, not a problem. But if you have to do that for an extended period of time,
Yes.
how does that, years, a 5-year loan and 18%, how does that work?
It doesn't fundamentally. Like, it bankrupts people. That's where, say, in our line of work, there are basically two things that you really want to avoid for preserving wealth through time. One is debt. You want to avoid debt, and you want to avoid gambling, because they're the only two vices that can effectively level any amount of wealth. And to the point around the workout, when you're working at 18% interest rates, well, you need 30% plus returns just to meet interest on that. And that's very difficult to get. And the longer that goes, the harder it gets. And the margins get crimped. I look at this and think, if we do have an extended period of rough times ahead of us where, say, interest rates start spiking, unemployment numbers start turning up, and people trying to work out of a bad debt situation in that type of environment, a lot of people are going to rip up an enormous amount of capital. And last time I checked, you probably got better numbers on this than I do, but I heard there was close to 200 billion in that private credit market in Australia. I think that is a huge number.
That's quick as well, right? Like
that's happened really quickly.
Really quickly. I mean, people, this is not an Australian phenomenon. It's a global problem that, higher the leverage, the better the trade, the better the outcome, the better the return.
Yeah.
But at, high double-digit interest rates, it's tough.
Yeah. On that, and this is where I think the Australian, say, investing, it's really a global phenomenon, but to make it local from an Australian perspective, when we think about investing and what we look at, a lot of clients get obsessed with income because they think there is a much lower risk attached to the income. And I think it's important to look at the capital efficiency of a portfolio rather than just what income is it generating, because you need to look at that after tax, what that looks like. And just a really brief example here. A lot of people want that peace of mind that comes with an income. And I look at that and think, from a capital efficiency perspective, that peace of mind you are paying through the nose for. And I'll just give you a quick example. If I want to generate for a client's portfolio $1.5 million in cash from an income producing asset, I need to find a stock or a REIT or a mortgage fund that's going to pay me 8%. And I need to put in roughly $37.5 million of capital to have that $1.5 million in cash available on a per annum basis. 37.5 mil generates 1.5 mil once you've taken into consideration income taxes and using that money personally. Alternatively, looking at a growth style portfolio, and this is to me what Bitcoin represents, and to your fund, the beauty of it, because there's no income to it and people confuse the risk and volatility. But when you have cash generated from a capital appreciation rather than income, to get that $1.5 million in cash, I only need $10 million growing at 15% per annum to provide that cash. And I look at this and I haven't heard anyone else talk about capital efficiency in total return, when considering total return and the effects of tax on compounding through time.
It's really interesting because I hear the same comments that, everyone chasing income. And the other thing I hear too is, it's fine if we get the income, but then the asset value goes down, still getting the same income. But by definition, the creditor is like, we need more cash.
Yeah.
So you can have that target, let's make $1 million a year cash flow, but your commercial real estate or, farm goes down 30%.
Yeah.
Then there's a call, right? So that $1 million is, that target is irrelevant, and you've lost, multiples of that on the asset valuation.
Correct. And this is the illusion of peace of mind from an income strategy. And I look at this and think, you think you can sleep well at night. It's only because you don't know what you don't know.
As in, you've invested in some sort of private deal
Yeah.
You don't have the transparency that you should have, but that makes you comfortable because you don't know what you
Correct.
don't know. Yeah, right.
You trust the people you're investing in. And so because you don't understand what the systemic risks in the system are, you think everything's okay. And let me give you an example of two examples in property, because really the conversation I try and have with clients is really focused on Bitcoin, because it's like, you think you understand the risk there, but let me try and get you up to speed on here, because there's far greater bang for your buck over here on a risk-adjusted basis relative to property. And the two things that I look at, say with property, the huge amount of property sitting in superannuation funds. Most people don't really comprehend the risks associated with that, in that when property is held in a superannuation fund, you only need to revalue that property once every 3 years. And so your big industry funds, your big retail funds, they're sitting on commercial properties that could be, and I'm not saying this is the case, but there's a very possible likelihood that those properties are off 30% book value to what the actual value is. And the commercial brokers that I talk to, 2 years ago, if you wanted to buy a commercial property, you had to pay 10% above book value. And now you're paying 30% below book value. So that's a 40% differential in that. That's the first point I'll make about property. And most people, just Australians, don't want to hear it. It's like, look, this is just the market, and you want to consider. The other thing is how you value a commercial property. I've got to say, is breathtaking in its ability to, I believe, deceive you. Would be the words I would use. And let me give you this example. Let's just say we've got a property worth $100 million, and we're getting $5 million a year rent. So it's on a 5% yield. If we give property incentives of 50% for the first 5 years of that lease agreement.
Just to clarify, that's for people to come and lease off.
To come and lease this property. So in my head, we've just got 50% less rent. So in my head, I'm thinking, well, clearly the property's worth 50% less because I'm now getting half as much rent.
Or your cap rate's 2.5%.
Correct.
Yeah.
Choose your own adventure. But I think the value of the property should be 50% less. That's not how the commercial market sees it. How they see it is, well, we've given a discount of $2.5 million a year for 5 years, which adds up to $12.5 million. So we're going to use the initial value of a $100 million property. We're going to deduct those effectively incentives that we've given, and we're going to value that property at $87.5 million, because $100 million less your 12.5 gives you $87.5 million. Now there is a $37.5 million differential between what I think it's worth and what the market or the valuers say it's worth.
And the credit line is provided on the 87.5, I presume. So you don't need much in the way of, disturbance to adjust that 87.5 potentially lower.
Correct. It gets, and this is what we saw in the GFC, particularly with the funding on pubs. You saw that lending ratio on pubs move very quickly in the wrong way. And a lot of publicans were caught offside with that.
Yeah. Yeah. And again, I'm not a commercial real estate, but it seems to me that leverage is always held pretty high too, right? To pump up the IRR or keep the IRR high.
Correct. And this is one of the things about property. In order to juice the returns, you need to increase the debt. And then over time, that debt becomes relatively a nothing burger relative to how much the value of the property is. But in order to juice the returns and maximize the returns, you really need to use debt in quite a heavy way in order to get the best outcomes from that internal rate of return perspective.
Yeah, that's interesting, isn't it? So, real estate, the commercial end, highly levered, vulnerable, higher rates, as you say, less tenants. It's a bit of a minefield. The other thing one of the other things I wanted to talk to you about is, we've looked at, let's go back to resi. So resi's increased, let's say, between 7 and 8% on average over the last 10 years. The work I'm looking at now, is it the house price going up, or is the denominator as in monetary debasement going up?
Depends who you're asking, I think. And to your point, we have a severe problem that most people are unaware of. And this is, we're running a debasement on the value of our currency that you and I get no vote on. So over the last 5 years, our currency has been debased by 50%. Ironically, residential property has probably gone up 50%. And you look at those numbers, it couldn't be more than 1% to 2% differential over a 5-year period, which is highly correlated. So you sit there and, because of the work we do, we'd look at other assets, uncorrelated, the rest of it, assets that don't have the ability to be debased, and think, is that really, capital appreciation that you're seeing, or is that a currency debasement? And personally, I would think it's a currency debasement, not a principal appreciation in an underlying value of a property.
Yeah. I mean, I totally agree. But the debasement doesn't include inflation. Is that your understanding as well?
I agree with that.
So
that was just the monetary units.
Yeah. So that's the central bank issuing or debasing debt to equivalent of that level. Let's say 7 or 8% a year. Then you've got to add inflation on top of that. So let's call it 7% plus 3%. So 10% purchasing power.
Yeah.
You're losing every year.
Yeah. And how I look at this in 2 very simple terms. If you look at a transaction, basically somebody is selling something and somebody's buying something. So in your example, the debasement happens to the money.
Yeah.
And the inflation happens to the asset that you buy.
Yeah, that's a good way.
But you need to add those 2 together in order to get the total debasement or inflation, or debasement plus inflation that you look at. And we're running at 10 or 11%.
So for a simple guy like me, if you're not making on your assets income, wage growth, more than 10%, you're running flat.
Correct.
So okay, so this now gets interesting, right? So my guess is the attempt to try and keep residential house prices going up like it has been. So that means more printing, more debasement or issuing of bonds by the government. But you need an asset, if you want to make and save money and get ahead, as we like to call it here, you need to be outperforming 10% substantially.
Yes, that's the difficult thing to do. Outperforming 10% returns. You're a professional money manager. That's no easy feat. People spend a full-time job on that, and by the very definition of it, most people can't make that return.
That's amazing. So, do you know any assets that could make that return? Pete, so obviously the Bitcoin, we've had a pretty impressive last couple of days. You're one of the strongest advocates in Australia for this, as I am as well. We come at it from a slightly different angle, but our rationale is very similar. So let's talk about, you've got a client that's got substantial commercial real estate, obviously residential because they live somewhere, heavily weighted, probably bank stocks and blah, 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 portfolio. How do you think about allocating percentage to, I know everyone's different, but if you were starting out, how much would you say? Because I'm trying to beat 10%.
Yes. And so by very definition, you need to have the highest allocation possible. This is for every client I speak to. I want them to have the highest possible asset allocation to Bitcoin, because I think it's the risk-free asset and I think it's going to outperform everything else. And so on a personal note, I'm trying to start at 10% conversation. Now, I've had clients who have sadly passed away and they were 88 years of age and they had 60% of their net assets, investable assets in Bitcoin.
Wow.
Yeah. And the conversation, yeah, that's what I think too. I was so proud of.
Straight away, 60%.
Not straight away. Started at, I think, a total of 7, grew into 60. And when, sadly, that client passed away, I had to have a conversation with the kids. And any respectable or, we've got a fiduciary duty to clients to make sure that, we're doing everything by the book and in their best interest. But, there's a glaring stat when you're looking at the portfolio asset allocation and, more than half of the pie is taken up with Bitcoin. You look at that and think, we need to have a conversation about that. And we did have a conversation about that and said, look, 60%, we should look to rebalance the portfolio. What do you think about that? No, we don't want to do that. We're happy with what we've got. We're fine with that. I was like,
wow.
Tick a box, happy. So,
and is that like recently or?
That would be 3 years ago.
Yeah. So the question now is, what's the Bitcoin percentage now?
I think it really is twofold, that question. To me, it's whatever you can stomach.
No, but in the sense of it was 63 years ago. Now we're back at the
it'd be 80?
Be 80, yeah.
Yeah, 80 plus. So, and the clients are over the moon, delighted with that exposure.
Yeah, I would be too. What did you call me 3 years ago, Pete?
Yeah.
Because one of the charts that you showed me the other day, and I forwarded around to a few people, is that buying an Aussie residential property, not in Aussie dollars, but in Bitcoin terms, has been a phenomenal chart.
Yeah.
And so, I mean, we're sort of playing, I'm not trying to play devil's advocate, we're coming from the same side here, but that's where I think an allocation to Bitcoin and digital, whichever format you want to do, is really important.
Yeah, me too. And this is where that property market, particularly residential, is highly geared, I believe. And there are a whole host of banking policies that go into ensuring that market is protected. However, it's usually very difficult to find additional capital to offset the risk in holding that asset. And this is where, from a personal point of view, I think there are huge pools of capital in superannuation that can access Bitcoin and crypto. And it's like, to me, that's where you get the counterweight to the overexposure to the Australian property market, because it's a pool of capital that doesn't cost you anything from a household budget perspective, because, when rates move from 0% to 5%, there is mortgage stress. Now, we don't talk about it because guess what? Every newspaper, every media outlet, every bank, every major institution is in the bag for property. So mortgage stress, we don't want to talk about
it's got to be happening, right? We've seen the numbers. We've seen the COVID financing levels to, resetting now. It's gone from 2 to 6 or 7. It's happening, right? And we all know it. I think the other thing you alluded to earlier is, unemployment. Sadly, looking at the latest data, it's, the private sector's not looking great.
Struggling.
Really struggling. And the government's picking up that slack, sort of, I don't think intentionally, but, it's muddling the numbers, right? I mean,
yeah,
there's not many people you or I know hiring people at the moment.
In private sector, no.
No.
And this is that obfuscation of making something very opaque. Top line number looks really positive. Look at Australia's growth in employment. Amazing. Wonderful. And then you extract all of the government jobs out of there. There's nothing for the private sector, which means you're effectively breeding expenses.
Yeah.
Because it's not productive.
It's not, well, I think, so I had a really interesting conversation with quite a senior person, and the highest tiers in Australia. His comment was, we have a productivity problem and we have an innovation problem, as in not encouraging innovation enough. It's still a very, it's the same model we've had for 50, 60 years, right?
Yeah.
Buy your own home, lever it, do other stuff, roll it up into the next house, roll it up. Not enough encouragement, tax incentives, whatever you want to call it, for the innovation to drive the next level of productivity.
Yeah.
And I think we're seeing, AI is obviously front and center at the moment. I think crypto, Bitcoin is very much part of that conversation as well. And to me, those two things could really drive productivity and try and address some of these inflation issues.
Yeah, I agree with that. And the precursor to productivity is capital. You need to have capital, and the poor allocation of capital to unproductive assets, and I put property in this because it's not really a productive asset, it's really a rent-seeking asset, is a huge problem. So in order to chase your AIs and your tech innovation and the rest of it, you need to have capital, available capital. And to me, globally we have a debt problem, but the flip side of that, or the other side of the balance sheet, is we've got a capital or a collateral problem. And I look at this and I think, well, we're not squeezing any more juice out of the property market, which is where the bulk of that debt has come from. Outside of governments, the bulk of the debt is generated through credit, effectively credit creation. How do you create debt? And this is where, to me, the opportunity with Bitcoin, once people understand what this is, it's the perfect collateral. Like, it is the perfect collateral. Now, in Australia, because we're so obsessed with property, we think the perfect collateral is a 2-bedroom unit in Sydney and a suburb and blah, 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 because that's what the best interest rates are going to be from the bank's perspective. But on a global scale, on an objective basis, Bitcoin is the best form of collateral ever invented. And if you even have a modicum of some of the government policies aimed at helping people buy and own Bitcoin as opposed to commercial property, you can have the ability to kill two birds with one stone. You can increase that capital base of the country, whether it's the US or here, dramatically. And by incentivizing and effectively creating credit products around Bitcoin, you can create that capital base, which will grow faster than any other asset class. At the same time, you don't withdraw the credit privileges that you've afforded to the property market because you don't want to collapse, but there'll be a natural attrition migration from property investors into digital. And that will not only give you the fastest growth of capital that you can possibly have, but it'll also give you a very nice deflation on housing affordability, which is obviously a huge trigger point for our governments. And just so, I guess, the world knows I'm not just a negative Nelly on property, there are probably two policies, one in particular I could give you that would see property prices double, and then, you think we've got a problem now. Well, wait till these policies get instituted, the properties double in the next 3 years.
I agree, and we're coming from the same boat here. But I think the other interesting thing is some of the institutions that are coming to this, and Australia slows so far, which is not abnormal in a lot of these sort of innovation type products. But when I see obviously BlackRock being the headline of acquiring the assets, but then I see and other institutions allowing investors to get involved. But then I see the periphery starting to get involved. When I see the custodians, traditional third-party custodians, and even, banks offshore, Standard Chartered in Singapore and Hong Kong, DBS, these are really old establishments realizing that there's a need, and they need to solve for both institutions and individuals. But I think the third-party custody, for me, is a really interesting one. You've got Mellon, Bank of New York Mellon. They're one of the top two custodians on the traditional space.
Yeah. In the US too, you've also got Northern Trust.
And Northern Trust as well.
Isn't well known.
Yeah.
And they are arguably the best name in North America when it comes to that.
Exactly right. And to me, that is, probably not super busy with, holding assets yet, but there's a lot of work being done. Yeah. And to me, that's lining up for real traditional larger institutions to follow the traditional model of third party, unencumbered, no correlation to the execution desk and where the assets are held. And, in my previous life in the bond world, this was the only way people did it.
Yeah.
They wouldn't do the bonds and then custody with you. It had to be someone else, and preferably one of those third party entities. So there was no correlation.
You're just minimizing risk, right?
Just absolutely minimizing counterparty risk. Someone to hold the assets, someone to trade the assets. You trade them, you give it to the person that holds them. And I think that's going to be that's going to be a big thing going forward. But I was surprised how quickly they came. And they're not doing it because they think it's coming. They're doing it because, my guess, it always comes from the customer side. The customers we need a, traditional structure around holding these assets for us.
I agree. And probably the most important person in the space who's doing that is Saylor with MicroStrategy.
Yes.
I think he would ideally love a traditional custodian to look after it, because BNY Mellon or Northern Trust looking after his Bitcoin looks a whole lot better than Coinbase.
Yeah, and I think that's I don't think Coinbase is doing anything wrong. I just think it's the traditional model. You can go and trade a lot with JP Morgan, but still they'll give it up to a third party in the traditional world. It's just the way it worked, managing counterparty risk. So Michael Saylor, flavour of certainly the last year, but maybe longer, and definitely the last 3 weeks, and definitely today. Obviously running a corporate balance sheet, done very well. Can you just walk us quickly through how that works? But I also think that evolves into other corporate financial balance sheets. But it's sort of a metaphor for your personal balance sheet.
I agree with this.
That's what I think that's where we get to. Now, obviously, he's got the ability to fund very cheaply at the moment, but I think that rolls into the personal balance sheet.
One affects the other.
Yeah.
And I think in his case it does. So what is completely counterintuitive, and this is where Bitcoin just breaks everyone's brains from a traditional finance perspective, from a corporate finance perspective, what he is doing is he is issuing stock, which is a major no-no. If you want capital appreciation, you don't want to be diluted, but he's issuing stock, raising billions of dollars and then going and buying Bitcoin with that. And in the last 4 years, he has been the most successful company in the S&P 500, even outperforming NVIDIA, which is a tough ask. And I look at this and think, how's he done it? In conversations I've had with friends who are in the traditional finance space, I've said, Warren Buffett acolytes who absolutely love what Warren does, and he's been a wealth of information. I said, you've really got to get on this stock, have a look at it. Incredible, doing things that are completely unique. Oh yeah, what does he do? He buys Bitcoin and he issues stock and buys Bitcoin with it. Oh, well, I don't want to be diluted. It's like, don't worry, you're not being diluted. He's actually Bitcoin accretive per unit, but he's actually diluted for the number of shares. I don't get it. Why don't I just buy Bitcoin? Oh, well, he's got funding rates at 0.8%, so he can issue convertible bonds and have an interest rate like $4 billion outstanding, and he's got an interest rate which is more than 80% lower than the US Federal Reserve.
So this is the important bit. So someone recognizes that this is great collateral, right?
Yes.
And so they're issuing it, let's call it 1% for argument's sake, 300, 400 under the Federal Reserve.
Yeah.
And now he's probably been, a lot more aggressive than anyone else, clearly. Yes. But why wouldn't other balance sheets, I know that Microsoft's going to a vote on this, but clearly not as much as percentage of the balance sheet. But why wouldn't you start that in your balance sheet? And then, if you're a big corporate and you've got the ability to go to capital markets, the wholesale capital markets. I mean, to me, borrowing money at 1% now is...
Do it if you can. If you've got... The problem for a lot of these companies, they don't have the ability to find an investment that they can get a return on relatively risk-free. They can't tap the markets for that. So when they're going to the markets, unless they're going to buy Bitcoin with it, they're not getting interest rates at 0.8%. Because the total return, and this is what's interesting, is despite the fact that he's got the lowest interest rate available, what that market is telling me, just from a very simplistic perspective, is that we have the US Federal Reserve, the risk-free rate of the world. And what the market's telling you is that MicroStrategy, which is investing in Bitcoin, is a better bet than risk-free treasuries at 5%.
I mean, that's it, right? I mean, it's basically the market is telling you MicroStrategy's credit rating is better
than the US government?
Yes.
That's mind-blowing.
Yeah.
And they're buying Bitcoin with it. So he issues convertible debt. He's issued $4 billion. He went and bought $4 billion worth of Bitcoin, and his announcement today is he's going to buy another $21 billion over the next 3 years in convertible notes, and he's going to issue $21 billion worth of at the market equity.
Yeah, it's if you think it, from first principles, that's exactly what the market's pricing.
Yep. And
why wouldn't I just can't conceive why you wouldn't try that for some of your balance sheet.
This is because there's fear of the unknown, and the fear that we've had the last 15 years of being conditioned to say that all of the FUD around Bitcoin. Bitcoin is for criminals. It'll never work. The governments will shut it down. You name it, there's a whole host of reasons as to why you don't do it. And then it takes a visionary like Michael Saylor to implement this strategy. And unequivocally, the market has told you that his debt is a better risk than the US government's. That I find mind-blowing.
So let's knock that up one level. So let's go from corporates to sovereigns. Now, a lot of the sovereigns have got the problem of they are very indebted. So it's somehow, how do they pay that down? As in, how does their balance sheet go up against that debt? Number one. Number two, the implications are I hadn't thought about that, but it potentially means they can issue debt cheaper.
If they back it by.
If they use the same strategies as MicroStrategies.
Yeah.
Do you think, obviously, they know who Michael Saylor is and MicroStrategies. Obviously, the first thing everyone thinks about is, a faster asset going up to pay off the debt. But I hadn't thought about lowering your interest costs.
They should.
That makes a lot of sense, doesn't it?
Because this is the problem that governments have. They've got an affordability issue. Much like much of Australia and Western democracies, there's an affordability issue when it comes to property. And there's basically a spending problem with our governments. And if you can knock off 20% of the expense, which is basically by changing your rate from 5 to 1, then on the broader scheme of things, you've just improved your budget outcome dramatically. And that's before you get into the ability and the discussion that's been had around using Bitcoin from a long-term perspective to pay off the national debt.
Yeah, so that's separate to paying off the debt.
Separate.
But this is just your, whatever the US interest bill is on the P&L at the moment is 1.2 trillion, 1.3 trillion a year. It's bigger than the defense budget now. So if you could lower that to 200-300 million because of this strategy, wow.
Yeah, all of a sudden it totally redefines it. You've now got the ability to double your military spending.
And it also, it just, redefines the investment, macro investment thesis into the US, doesn't it?
There's no reason why the US can't do that, or Australia. It's just it's a problem of will. You actually have a playbook. Saylor, I'm sure, would be more than happy to disclose
Roll it out.
Anyone. And literally, he hosts conferences where he'll host companies and teach them how to implement his playbook. Hey, do you want to become the best performing S&P 500 stock in the world? Here's the playbook, play by play. He'll teach you how to do it. And this is the other interesting thing about Bitcoin, is that in traditional finance, it's a zero-sum game. You win, I lose. There's either side of the trade. Michael Saylor doesn't lose anything spreading his message on how to leverage Bitcoin and improve your balance sheet, strengthen your balance sheet, and outperform every other stock on earth.
You just can't imagine this not rolling out again, not to as aggressively as Michael has done, but just trying it, right?
Yeah, you would think, but I look at that and think there's a reluctance with the unknown. People don't want to risk it, and
is it regulation? I think that our view is there's a bit to that, because certainly at the corporate institutional level, there's always been if it's regulated by the government, accountability is passed on.
I think it's a lack of desperation.
Yeah.
If there's basically things are pretty good here. Those guys are, they're just ticking boxes. They've been vetted. They've got a process. They've done the 10 years training. They don't need to think outside the box. They want to collect their, golden handshake at the end of the next 5-year, 10-year ride, whatever they get to custody that enterprise for. What's the need to change it? Why rock this boat? They're retired. Once they get to that job, they're effectively retired. So you need to find someone with a desperation who wants to make an impact and has the ability and the voting power to do that.
Do you think we get to the desperate levels in this cycle?
No.
In Australia or globally?
Globally, neither. Maybe in 2 years' time, maybe
Yep.
on the tail end of what I think will be a crack up boom. I think all of those, the tech stocks, Bitcoin, they're going to be the best performing assets over the next 2 years. And then maybe on the tail end of that, maybe there is going to be the desperation. But what's really interesting is, and this is where, say from a portfolio allocation perspective, Warren Buffett has been the benchmark for the world's greatest investor for the last 50 years. He's a value investor. And what's really weird to see is that the value stocks have, because of the over-engineering or financial engineering of their balance sheets, have now become risky. Whereas the tech stocks that are trading on stupid multiples of 30, 50, whatever it might be, are actually very low risk, relatively speaking, because they've
cash balances too.
Huge cash balances, huge cash flows, very little debt.
Yep.
Whereas if you, I guess, rewind 10 to 15 years, you had the value stocks had great cash flows, very little debt, and were strong balance sheets. You fast forward to where we are now, you've got the value stocks, overly financially engineered balance sheets, high debt levels, and they're on a treadmill. They have to keep running really hard because if they don't, they're going to fail. Flip side of that is the growth companies now are the ones who are spitting out cash, really strong balance sheets, and no need for debt. And I look at this and think,
and innovating, right? I mean, they're basically VC firms. They're buying on the innovation in creating it, the productivity they're driving, right?
Correct. And this is where both of those, whether it's a growth or a value stock, in any investment decision that you make or business decision, you need to look at what's presented in front of you and you need to look at the risk return of that. So what is the expected gain I'm going to get out of basically allocating that additional dollar of capital? In the value stocks, they're lucky if they get maybe a 10 or a 20% return on that money from allocating that dollar. In the growth stocks, they might be getting 30 to 40% if they're outstanding businesses. And then I look at this and think, for me personally, when I look at, okay, all of my investment options that I've got sitting in front of me, where do I want to allocate to? I believe Bitcoin is a risk-free 50% return. And I look at this and think, this is what I know. Wait until a struggling CEO of a value stock looks at this and thinks, hang on a second, I've got a chance to leapfrog and outperform a Google, an Apple, whatever style tech business by investing in this underlying commodity that no one really understands. It's only going to be a matter of time. And we're starting to see that filter through because we now have Semler Scientific, which is listed on the NASDAQ. We've got MetaPlanet in Japan. And there's a host of others, copycats that will come to market to try and, I guess, leverage off MicroStrategy's Bitcoin strategy. And this is where I look at this and think, all of a sudden it presents a very different problem for capital allocation, which is fundamentally what that CEO's job is.
Yeah, it's fascinating. You've got to think it rolls out. On a personal note, the rumor is true that you might have gone a little less long property and a little longer Bitcoin. Are they correct, Pete?
I promised my wife there was no more Bitcoin, so technically that is not true, but there might be a workaround there if we're lucky.
Workaround story of the day. So in wrapping up, how would you, someone that doesn't have Bitcoin at a household level or a personal level, how would you advise them now of how to get in? I mean, what I've seen in our funds management business is once people get in, they're very comfortable, but they've got to get in, right? And they don't have to start with a lot. They could start with, but once they're in, they sort of, go down that proverbial rabbit hole and do some education and learn about it. And then it's like, okay.
I personally think you would be an ideal person to talk to because you can merge the traditional finance with the new world. And having a mentor, a shepherd, someone who can speak both languages.
It's the nicest thing you've ever called me, Pete.
Yes,
the shepherd. I'm going to use that.
Well, it's really important because it's so confusing. And this is where I look at, say, what you do. There is very little risk from a custodian perspective because you basically have that all sorted. It's delivered in a very traditional means that, families, high net worths, investors, they understand. I'm filling out a form and sending you money. You take care of everything else on the back end of that. So I look at that and think, you're effectively top of funnel. That's how you start this process. And then just by osmosis and being around it and watching the returns that you get, all of a sudden it's skin in the game. When you're making money in this, all of a sudden it piques people's interest. It's like, oh, I'd like to know more. How do I, what's the next stage? You probably got clients who are like, oh, can you send me some more information on X, Y, or Z? Or, you shoot the lights out, say probably next month's monthly update will be a fun one for you to send out because it'll be
after this podcast. Absolutely.
Yeah. So I look at that and think that's the ideal way to start. But the most important thing is to start, and it will start to be a more significant part of your portfolio. But the longer you leave it, that's the real risk in not having it. So you need some exposure, however you take it. I'd start with you. You can go down the, full, tinfoil hat where you want to own the underlying, self-custody it and all of that. But
that's where people come to you. If they want Bitcoin alone, come to you. You look after exactly the same, right? They send you the money. You look after it. And most importantly, which I think, we're very aligned on here, is the custody safe, right?
Yeah.
And the treatment, anything happens to that holder, it's still recoverable.
Yeah. There's
no losing keys or any of this stuff. It is always available to come back to the owner or the estate.
And that's a big thing because
I think it's huge. Yeah.
With Bitcoin, it's a bearer instrument, and we've never had a digital bearer instrument. So many things can go wrong with it. 25% of all supply in Bitcoin's being lost for good. I look at that and think it's terrifying. And one small clarification, we don't take any customer money. We don't touch customer money. We'll advise through the process, and then we set it up in a way where clients can literally pass away. And we've sadly had to deal with 3 such instances, which was really sad. But from a family perspective, there was a question, hey, are we going to get our Bitcoin?
I mean, a valid question, right? Yeah. And I think, traditionally the media has been very vocal about that. And I think those solutions have been required. Now, Pete, you are been on the record of some fairly optimistic calls.
Yes.
Now, if we were sitting here, I'm not going to say next week, but let's say in 3 years' time, I'm not going to hold you to this. Where do you think ballpark we are in the Bitcoin price range?
I think conservatively 300 US.
300,000?
Yeah. So we're end of October 2024. In the next, call it 3 years, we'll see somewhere between 300 on the low side and...
Well, I want to know your top side.
Could see a mil.
Yeah.
Could see a mil, but if we see a mil, we'll probably see an 80% correction. So it'll come back down to earth pretty quickly, and then there'll be a whole host of people saying, oh, glad I didn't get in. And what's funny, the cognitive dissonance that if it drops, 80% from, $1 million, it's still going to be 3 times higher than where we are now.
Yeah.
So
yeah, it's a very unique market, isn't it? Yeah. The highs, everyone wants to completely buy it.
Yeah.
Out of the lows, it's like, I knew I should never have got into it.
You cannot give it away.
Yeah.
And what's really funny is, I would urge everyone to get some exposure to Bitcoin and crypto. And just for the very fact that it will inoculate you from the concerns of the volatility of your traditional portfolio. Once you experience Bitcoin and crypto volatility, standard market volatility just doesn't even raise the cortisol.
So true. It's so true. Well, Pete, thanks for joining us, mate. I could sit here all day with you. Really good. We'll definitely get you back. Always lots to talk about. Thanks to the listeners and the viewers for joining us on Unblocking the Chain. We'll get Pete back in a couple of months and see how his predictions go. Thanks, mate.
Thanks, mate. Appreciate it.